Hey everyone, welcome back to Corporate Decoder. Today, Harvard Acquisition Corporation DOT HAVAR just filed its latest quarterly report, and I am seeing some interesting moves in their trust account, which matters a lot for SPACs. Quick note, this is not financial advice, just my take on public filings for educational purposes. So, this company is looking for a merger, and what they do with their money in the trust account is super key to understanding their financial health and their ability to make a deal happen. Let's dive into the numbers right away. On their balance sheet, we see their investments held in trust account as of the 30th of June 2026, standing at a hefty $148,612,304. That is a big chunk of change. Comparing this to the 31st of December 2025, where it was $146,003,054, we see a solid increase. This means they are growing the money in their trust, which is generally good news for a SPAC. It suggests they are either earning interest or managing this money well while they look for a target. Now, there is something called a related party receivable, which is $770,645 as of June 2026. This basically means money that is owed to the company, but is held by a party related to the sponsors. They don't have direct access to it yet, which is a bit unusual, but it is a number to keep an eye on for clarity on where their cash really is. Looking at how they are performing, their income statement shows a net income of $1,064,438 for the 3 months ending the 30th of June 2026. This is mainly thanks to the interest earned on their trust account investments, which was a substantial $1,312,067 for the same period. This interest income is crucial because it helps offset their operating costs. For this same quarter, their formation and operating costs were $247,629. So the interest income is more than covering those expenses, which is a positive sign. For the 6 months ending the 30th of June 2026, the picture is even stronger, with a net income of $21,99674. Again, the interest earned on their trust account, $26,09250, is the main driver here, significantly outweighing their formation and operating costs of $409,576. They also talk about weighted average non-redeemable Class A and Class B ordinary shares outstanding. This refers to the shares that are not expected to be redeemed by shareholders, which is an important metric for understanding the true ownership structure and potential dilution. On the financing side, their promissory note related party shows an outstanding balance of $308,910 as of the 30th of June 2026. This is a loan from a related party, and it is interesting to see it is still there, although decreasing from $331,730 at the end of 2025. There was also a small amount due to sponsors of $5,668 at the end of 2025, but this was repaid in March 2026, so it is zero now. This shows they are managing their liabilities. A big focus for SPACs is ordinary shares subject to possible redemption. As of the 30th of June 2026, they have 14,500,000 such shares, valued at $148,612,304. This is the amount that public shareholders could potentially redeem for cash if they don't like the eventual business combination. The value per share here is quite high, around $10.25, which is a critical number for shareholders deciding whether to redeem. Now, looking at their equity section, they have an accumulated deficit of over $4.1 million. This is common for SPACs before they complete a business combination, as they incur a lot of initial costs. It means that, on paper, they have not yet generated enough profit to cover their expenses since inception. For the 3 months ending the 30th of June 2025, they actually reported a net loss of $42,348. This was primarily driven by formation and operating costs. And for the 6 months ending the 30th of June 2025, the net loss was $64,170. This period predates the IPO. So it is all about the initial setup costs. The formation and operating costs are a consistent expense for the company, appearing in every reporting period. These are the necessary expenses to get the company up and running and to prepare for its public offering and subsequent business combination search. Managing these costs is key to preserving the capital in the trust account. The report also flags a going concern consideration. This means that based on their current financial situation, there is substantial doubt about their ability to continue operating for at least 1 year. While they have significant funds in the trust account, the uncertainty around completing a business combination and the related costs is the primary driver. This is a standard warning for many SPACs in their pre-combination phase. It is like saying, we are okay for now, but if we don't find a deal soon, things could get tricky. Their cash flow statement shows that for the 6 months ending the 30th of June 2026, they had net cash provided by operating activities of just $28,488. This seems small, but it is important to remember that most of their funds are in the trust account and not readily available for day-to-day operations until a business combination. In the management's discussion and analysis section, they reiterate that they are looking for a business combination. They expect to keep spending money on finding and evaluating potential targets, which is a normal part of the SPAC process. Their liquidity and capital resources section highlights the $148.6 million in the trust account. They plan to use this money for the business combination. They also mention that their sponsors or management might provide additional loans if needed, but there is no obligation to do so. It is worth noting that the current market price for HAVAR Acquisition Corp rights, which is HAVAR, is hovering around $0.15. This is significantly below the $10 IPO price for the units, which suggests a lot of uncertainty or lack of confidence from the market regarding their ability to find and close a favorable business combination. The news headlines also show very little price movement, indicating a quiet period for the rights and perhaps a wait. And C approach from investors when we look at the overall picture. HAVAR Acquisition Corporation is in a typical SPAC situation. They have a significant amount of capital preserved in a trust account, which is earning interest and covering their operating expenses. The main story here is their ongoing search for a business combination. The accumulated deficit is expected, and the going concern warning is standard for companies in this phase. The key is what happens next, finding a good merger partner that creates value for shareholders. The risk I am watching is the ability to find a suitable target and get shareholder approval, especially given the current market sentiment towards SPACs. My biggest concern is always the potential for a dilutive deal or a business combination that doesn't significantly enhance shareholder value, which unfortunately is a common outcome for many SPACs. What I am actually looking for is a clear indication of a target or a strong pipeline of potential targets that align with their stated investment strategy. Alright? That is our breakdown of HAVAR Acquisition Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time. That is my take. Stay decoded. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below.